Have you ever felt confused or overwhelmed by all the advice about investing? Many common myths can lead us down the wrong path, making us think we need to follow certain rules or have a lot of money to get started. In this video, we shall uncover the top 8 investing myths that are holding you back from achieving financial success. By breaking down these misconceptions, we can help you make smarter, more informed decisions about where to put your money and how to grow it. Let's dive in. 1. You need to be rich to invest. In the past, investing in the stock market was considered something reserved for the wealthy. But in today's world, that is no longer true. With the rise of online brokerage platforms and low-cost index funds, anyone can invest, regardless of their income level. Back in the day, investing meant hiring a broker, paying high commissions, and needing a substantial sum of money up front. Today, you can open an account with as little as $50 and start investing in fractional shares. This means that whether you make $30,000 a year or $300,000, you can start growing your wealth over time. Plus, dollar cost averaging allows you to make small, consistent contributions to your investments, ensuring that you don't need a huge lump sum to get started. This myth often leads to the fear of missing out. You think you have to wait until you're rich enough to start. But the truth is, starting early with small, consistent investments is far better than waiting until you think you have enough money. Building wealth isn't about making a big, immediate investment, it's about being consistent and having the right mindset. 2. Timing the market is everything. It's tempting to think that if you can predict when the market will rise or fall, you can make a lot of money. Many people get caught up in the idea that timing the market is the key to success. But the truth is, trying to time the market is a losing game. Market movements are often unpredictable, and missing just a few of the best days in the market can negatively impact your long-term returns. Instead of trying to predict short-term fluctuations, the best strategy is to stay invested over the long term. Research has shown that consistency is the most important factor in building wealth. By investing regularly and avoiding trying to predict market moves, you will end up ahead in the long run. The key is participation, not timing. Think about it this way: if you had invested in the S&P 500 in 2009 and continued to stay invested through all the ups and downs, you would have seen incredible returns. By focusing on long-term growth rather than short-term fluctuations, you protect yourself from market timing mistakes that can cost you money. 3. Cash is king. This myth often circulates, especially during times of economic uncertainty. People say, in uncertain times, cash is king. While it's important to have cash reserves for emergencies, holding too much cash can actually cost you money in the long run. With inflation steadily eroding the value of your money, keeping your cash sitting idle means losing purchasing power over time. The key to managing cash effectively is to strike a balance. Keep enough cash on hand for emergencies, like 3 to 6 months of expenses, but don't let excess cash sit in your savings account, earning next to nothing. Instead, look for ways to invest your cash to ensure it grows, even during tough economic periods. You can invest in stocks, bonds, or other assets that can keep up with inflation and provide you with better returns over time. While cash may feel safe in the short term, it's your investments that will help build long-term wealth and secure your financial future. Think of cash as part of your financial toolkit, but not the cornerstone of your wealth-building strategy. 4. Bonds are safe investments. Many people think that bonds are a guaranteed safe investment. Bonds have long been seen as a low-risk, low-reward option. While some bonds, like U.S. government bonds, are indeed safe in terms of default risk, the truth is that not all bonds are created equal. Bonds can lose value, especially in a rising interest rate environment. When interest rates go up, the price of existing bonds goes down. Additionally, bonds can offer lower returns compared to stocks over time. While bonds might provide stability during market downturns, they also typically lag behind the growth potential of stocks in the long term. This means that, if you're relying solely on bonds for your investment strategy, you might not see the growth you expect. The key here is balance. Incorporating both stocks and bonds into your portfolio, in a way that suits your risk tolerance, can provide the best of both worlds, stability with bonds and growth potential with stocks. Don't fall into the trap of thinking that bonds are always safe without understanding the risks and returns involved. 5. The stock market is like gambling. Many people think of the stock market as a form of gambling, where you bet on whether stocks will go up or down. But in reality, investing in stocks is very different from gambling. Gambling is about short-term speculation and the luck of the draw, while investing in stocks is about long-term strategy and building wealth over time. In fact, the stock market tends to reward investors who are patient and stick to a plan. If you buy and hold stocks for the long term, you have the potential to see consistent growth, even during market volatility. While there's risk in investing, it's important to remember that the market doesn't care about individual outcomes. It's driven by the broader economic fundamentals, such as company performance and economic growth. By diversifying your portfolio and focusing on long-term growth, you can reduce the risks associated with the stock market and avoid the gambling mentality. Stick to sound investing principles and let the power of compounding work in your favor. 6. You need to pick the perfect stock. A common myth is that, in order to succeed in the stock market, you must be able to pick the perfect stock, the one that will skyrocket in value. This mindset can lead to disappointment, as no one can predict stock prices with perfect accuracy. In fact, trying to pick individual stocks based on short-term trends is one of the riskiest ways to invest. The key to successful investing isn't picking the perfect stock, but rather creating a diversified portfolio that aligns with your long-term financial goals. By investing in a mix of index funds, ETFs, and individual stocks, you spread out the risk and allow your investments to grow over time. Remember, diversification is the key to reducing risk and improving your chances of success. 7. You can't start investing with little money. A common myth is that you need a large amount of money to begin investing, but that's simply not true. In today's world, starting with a small amount is more than enough to kickstart your investment journey. Thanks to tools like fractional shares, robo-advisors, and low-cost index funds, you can start investing without needing thousands of dollars up front. These options allow you to invest in high-quality stocks or funds with just a fraction of the price, meaning you don't need to wait until you've accumulated a large sum. The key is to start small and be consistent. With dollar cost averaging, you can invest a fixed amount of money regularly, say, $100 or $200 each month, without worrying about market timing. Over time, your small contributions will compound and grow. While it may seem like a slow start, remember that the sooner you start, the more time your money has to grow. Small, consistent investments can lead to substantial long-term wealth. 8. Past performance guarantees future results. Another myth is that the past performance of an investment guarantees its future returns. While historical data can give you a sense of how a stock or fund has performed in the past, it doesn't predict future success. Markets change and conditions can shift, so relying solely on past performance is a mistake. Instead, focus on building a diversified portfolio with a long-term strategy. Consider fundamentals, such as company health, market conditions, and economic trends, rather than relying only on what a stock has done in the past. Over time, a strong, diversified portfolio will help you weather the ups and downs of the market and achieve your financial goals. And that's a wrap. We've cleared up 8 investing myths that could have been costing you valuable opportunities. Now, you're equipped with the truth, and it's time to take charge of your financial future. Keep these tips in mind as you continue your investment journey, and remember, knowledge is power. The more you know, the more confident you'll feel in making the right choices. If you enjoyed this video, make sure to like, share, and subscribe for more tips on smart investing and financial growth. Thanks for watching, and I'll see you in the next video.